we're going to talk about the foundational pillars of personal finance. If you go to a financial advisor of any kind, I don't care who they are. They could be a Dave Ramsey financial planner. They could be, there used to be a group called USPA and IRA. All kinds of financial planners out there that will probably go through these areas: income, savings, insurance, debt, and investing. In the middle of all this, they may not talk about this, but time is your most precious commodity. Okay. And the goal ultimately is use our time, because we use our time at work to make money, and then we use that money to do things. And if we do it right, or do it in the ways that we're going to talk about, then that money can actually allow us to use our time in ways that we want to use them. Okay. So that's the goal, or the dream anyway. So before we get it started anywhere, we'll talk about building wealth and investing and all kinds of things. The first thing we need to look at is you got to start somewhere. And the first thing you got to do is get a job. You got to start the income somehow. It could be also start a business, but you're basically working. Okay. But in other words, you're going to spend time at work and somebody's going to pay you for your time. Okay. Now, eventually, if you are a business person or an entrepreneur, you start a business, you can get business profit put into your pocket. And that could also be a source of income. Now, side note, as an entrepreneur, many times profit is put back into the business to make the business grow. Okay. So we're going to go into that way deeper later. And then there's investments, where you're basically giving other people money. They're using their money to grow their business, and then they're paying you back. That's the short story. Okay. So there's all kinds of things out there. Dave Ramsey is a really popular person to go to. You can very easily find his stuff online. So I highly recommend that use his resources as a great jumping off point. We're going to compare and contrast some other ideas as well as we go forward. Okay, so you've got income. The next thing that we need to think about, the next pillar, is savings. So the purpose of saving money is to manage that risk, the potential that I might have a problem I have to deal with. But for example, a flat tire. I don't plan on going out and putting a hole in my tire and making my tires flat. It happens, and it's unexpected. So when I put money away or put money to the side in anticipation of that risk happening, that thing happening, I didn't have money to pay for it. Okay. So an emergency. Now, of course, some people use their savings fund for things that are not emergencies. So an emergency is something that really is you not looked for, not planned for, and it affects your use of time or chance to work. To me, that's really an emergency. Am I taking care of family, that kind of a thing? Actual emergencies. Okay, we can also use savings to make large purchases. If I know I'm going to buy a car, I could start saving that money, because if I can, the more I can pay cash and the less I use debt to buy a car, I'm actually going to save myself a bunch of money. Okay, so we can use it for both. Now, we're going to talk about this some more later, but you can go to the bank and you can open up a checking account and a savings account. Checking account, usually that's where your income, your paycheck goes into, and you withdraw, put in money, all kinds of stuff. There's no problem. You just do it. Okay. With that said, you should always make sure you know what the bank's agreement is, because sometimes there's a minimum number of purchases or transactions on either of these. But usually there really is something like that for a savings account. In a savings account, the bank is counting on you not spending that money, okay? Because the bank is actually going to use that to loan money out to people, okay? So that's when we talk about banking, we'll talk about that later. But when you open up a savings account as a person, the bank is going to actually pay you some interest for keeping money with them in their bank. Now, generally, it's a low interest rate, 1% or less. We'll talk about interest later. And it's it's really the place where you should keep things for emergencies. And this is for liquid emergencies. Liquid funds means that I can draw it right now if I needed to. Okay. So there's other ways to save that are not as fluid. And if it's really for an emergency, that may not help you. Okay. All right. We're going to come back to this. I'm going to get off track if I stay on here too long. All right. Next one, insurance. The purpose of insurance is to manage risk. Okay. So savings is one way to manage risk. Insurance is the other way. So the average type of insurance is completely about managing risk. So for example, life insurance, the risk is you die, but you leave people behind, whether it's a spouse, children, or parents. Even if they're not dependent upon you, they still have to pay burial costs. They still have to take care of things. Basically, what you want to do, you want to make sure that whoever is left behind isn't having to pay the cost financially for you being gone. Okay, so for me, I'm married, I have kids, and I'm the number one person who makes money in my house. So if I were to pass away, my wife would not have that. So I should have a pretty decent life insurance plan so that they can be taken care of. So we're managing that risk. Okay, medical insurance, you get sick. Okay, well, you need to take care of yourself by paying for the doctor, but you can also lose income because you're not at work. So this is where workers' comp and some other things like that come in. So that's the risk you're managing there. Car insurance, the risk you're managing is car gets damaged, now you can't drive it, or people get injured. Car insurance covers those things. Now, some insurance companies or insurance things work on the idea of sharing risk. And okay, actually they all work on the sharing. And this is how it works as a financial thing is if 1,000 of us are buying car insurance, how likely is it that all of us are going to have an accident on the same day? Not very likely. So when, let's say, for example, I do have an accident, then they can pay for the accident, but yet they're still getting money from everybody else. Okay. All right. Now, you usually also spread that payment out because you're paying regularly, monthly, quarterly, or even yearly. And some of these are mandated by law, like car insurance, got to have if you're driving. Pretty much every state requires it. What level of insurance differs depending on the state. You can always get a higher level of coverage than the state requires, but it's going to cost you a little more. But it may or may not be worth it for you, depending on how much you're driving, you're doing, all that kind of stuff. Okay. But that is insurance. It's to manage your risk. Okay. Debt.